Today we're exploring the most versatile and industrially critical precious metal, silver. From ancient currency to cutting-edge technology, silver drives innovation while preserving wealth. We'll examine its supply and demand dynamics, industrial applications, recent surge, and the strategic mindset of both professional and retail investors. Silver's global supply, concentrated yet constrained. Silver's total above-ground stock is estimated at 1.6 million metric tons, roughly 20 times more than commonly reported identifiable stocks. Yet this seemingly large number masks a critical reality. Most silver is permanently consumed in industrial applications, making available investment supply far smaller than it appears. Annual mine production stands at approximately 830 million ounces, 25,800 tons, but this has been declining since peaking at 900 million ounces in 2016. Here's what makes silver supply unique. Key producers by region. Mexico leads globally with 6,400 metric tons annually, 24% of world production. China follows with 3,400 metric tons, 13%, though declining due to depleting ore grades. Peru rounds out the top three with 3,100 metric tons, 13%. Chile, Bolivia, and Poland each contribute 1,400, 1,600 metric tons annually. Critical supply constraints. Unlike gold, 70–80% of silver comes as a byproduct of copper, lead, and zinc mining. This means silver supply depends heavily on base metal economics, not silver prices alone. Primary silver mines contribute only 20–30% of global production, creating supply inelasticity that can't respond quickly to price signals. Demand, where silver truly shines. Silver's demand structure fundamentally differs from gold, creating unique market dynamics across four major categories. Industrial applications, 50–60% of demand. Silver's unmatched electrical and thermal conductivity makes it irreplaceable in high-performance applications. Industrial demand reached 680 million ounces in 2024, with electronics and photovoltaics leading consumption. Solar energy revolution. Photovoltaic applications consumed 197.6 million ounces in 2024, nearly 17% of total silver demand, up from 5% in 2014. Each solar panel requires 15 to 20 grams of silver paste for efficient electron transmission. Despite thrifting efforts to reduce silver content, the explosive growth in global solar installations continues driving record demand. Electronics and technology. For the first time in generations, central banks are exploring silver allocations to diversify reserves beyond gold and dollars. Even modest central bank buying could significantly impact the relatively small silver market. Investment demand, 20–25% of total. Physical silver bars, coins, and ETFs provide portfolio diversification. Silver ETPs experienced record inflows of 95 million ounces in the first half of 2025 alone, surpassing all of 2024. Global ETP holdings now exceed $40 billion. Jewelry and silverware, 18–20%. Traditional demand from jewelry manufacturing and decorative items remains steady, though overshadowed by industrial growth. What's driving silver's recent rally? Silver has gained approximately 40–50% year-to-date in 2025, reaching 14-year highs above $46 per ounce. Unlike previous rallies driven purely by speculation, this surge reflects fundamental supply-demand imbalances, structural deficits. Silver markets have recorded deficits for 5 consecutive years through 2024, with cumulative shortfalls exceeding 800 million ounces since 2021. Industrial demand growth consistently outpaces mining supply increases. ETP-driven investment flows. Record inflows into silver ETPs removed 95 million ounces from available supply in just 6 months. This institutional participation differs markedly from previous retail-driven rallies, suggesting greater sustainability. Green energy transition. China's 45% increase in solar capacity in 2024 alone demonstrates the scale of silver demand from renewable energy. With global solar installations projected to exceed 4,000 GWs by 2030, silver consumption will only intensify. Central bank interest. For the first time in generations, central banks are exploring silver allocations to diversify reserves beyond gold and dollars. Even modest central bank buying could significantly impact the relatively small silver market. Institutional versus retail, the great divide. Unlike gold, institutional adoption of silver faces unique challenges. Why institutions avoid silver? Higher volatility, 30–40% annually versus 15–25% for gold, complicates risk management. Smaller market size, $40 billion versus $13 trillion for gold, limits large-scale allocations. Industrial demand correlation with economic cycles creates additional complexity. Storage requirements are 80 times greater per dollar value than gold. Current institutional holdings. Most institutional investors allocate less than 0.2% to silver, typically through commodity indices. However, recent research by Oxford Economics suggests optimal allocations of 4 to 6% for diversified portfolios, dramatically higher than current practice. Retail investor advantages. No need to justify complex industrial demand models to committees. Can capitalize on silver's higher beta to precious metals trends. Benefit from emotional and speculative price swings that institutions avoid. Storage and volatility concerns matter less for smaller position sizes. The silver investment mindset. For retail investors, silver offers both defensive and speculative characteristics. A strategic 4–6% allocation can provide portfolio diversification while participating in industrial growth themes. Key considerations. Volatility management. Expect annual price swings of 20–40%. Time horizon. Industrial demand provides long-term support, but short-term moves remain unpredictable. Form factor. Physical silver incurs storage costs. ETPs offer convenience but lack direct ownership benefits. Economic sensitivity. Silver prices correlate with industrial activity more than pure monetary metals. For professional managers, the traditional avoidance of silver may be creating opportunity costs. With industrial applications now permanent rather than cyclical, silver deserves reconsideration as a strategic allocation. Key reminders for silver investors. Supply-demand fundamentals. Unlike speculation-driven rallies, current dynamics reflect structural imbalances unlikely to resolve quickly. Recycling limitations. Only 15–20% of annual supply comes from recycling, and much industrial silver is unrecoverable. This differs markedly from gold's higher recycling rates. Gold-silver ratio, currently trading around 76.1. Historically high ratios have preceded silver outperformance. The long-term average closer to 15.1 suggests potential reversion. Industrial permanence. Unlike investment demand that can reverse, industrial consumption permanently removes silver from available supply. Summary and strategic takeaways. Long-term outlook. Silver's industrial demand provides fundamental price support unavailable to purely monetary metals, but requires patience for full realization. Medium-term dynamics. Supply deficits, ETP inflows, and green energy adoption create multiple supportive factors converging simultaneously. Professional allocations. Current institutional underweighting represents potential opportunity as industrial applications mature from cyclical to structural. Individual strategies. Silver's dual monetary industrial nature offers portfolio benefits, but position sizing should reflect its higher volatility profile. For comprehensive silver supply, demand, and price data, the Silver Institute's annual World Silver Survey provides the most authoritative industry analysis, essential reading for serious silver investors. Thanks for watching. If you're considering silver as part of your investment strategy, share your thoughts in the comments. Don't forget to like, subscribe, and hit that notification bell for more precious metals analysis. See you next time.